In Chapter 5, we're going to discuss risk and return. And although it's going to seem a little powerful, maybe, a little overboard, if you will, it's important to have a basic understanding of the process of calculating risk to understand what it means for us. So, let's work our way through the chapter and see if we can make some sense of some of the information. We're going to talk primarily about interest rates determinants, not how interest rates are created, but we're going to talk about some parts. Excuse me. We're going to look at rates returns. We're going to talk about some premiums. We're going to talk about how you calculate risk and return. And ultimately, we're going to take a peek at what real data tells us about portfolios and asset classes that we can invest in. So the first thing we want to talk about is interest rates. So there is something referred to as a nominal interest rate. It's the actual growth rate of money that's stated. Now the challenge with the nominal interest rate is that it is taxed. However, inflation has an effect on our returns. And inflation certainly then is going to have an impact on the overall wealth that you receive somewhere out in the future. So we need to look and address a little bit of the real interest rate. Because remember, I might have said this in a previous slide, there's a saying that says, it's not how much money you make, it's how much money you keep that counts. Well, this does a little twist on this. It says, this isn't how much money you have, but how much your money will buy when you get it. So we need to look at what's referred to as the real interest rate. The real interest rate is created by supply and demand. It is influenced by inflation. And we have a formula here, right? The real rate is the nominal rate minus inflation divided by 1 plus inflation. We can do a shorthand, an approximation, and you just take the nominal rate minus 1. But let's continue on, look at some other things we might be interested in. So how does inflation affect interest? As inflation increases, the nominal rate of return increases. So the real rate is created by supply and demand. Then the return that we actually receive is then influenced by the inflation that's in the market. Now this formula is for a risk-free asset only. It doesn't take into account characteristic risks of things like stocks, bonds, corporations, etc. So let's expand one step further. Let's talk about taxes, right? Because in the end, we need to understand how much money you will be able to spend in real terms somewhere out in the future. So we have this rather long drawn out formula here where we can calculate the nominal rate. This is the after-tax nominal rate. If you subtract from the after-tax nominal rate, you're going to end up with, subtract out inflation, you should end up with the real rate. So again, as the after-tax real rate goes down, it falls as inflation rises. So that just hopefully makes sense, right? As inflation goes up, regardless of what it is, the value of what you have, whether it be before or after taxes, is going to decline. So this is utilizing the Fisher effect worksheet. And what this worksheet helps us do is to explore the impact of inflation and taxes on the after-tax real rate. So, if the nominal rate is 7% and inflation is 3.5%, what is the real rate? Well, if we go through this calculation, right, the first thing we can calculate is the after-tax real rate. That's this number down here is 2.1%. If you divide the real rate, again, if we want to divide the real rate by, this nominal rate by 1 minus the tax rate, that will give us the real rate before taxes. So in this case, we have what? The real rate's 3.5%. When you include taxes, 40% says the after-tax real rate is 10%. So now what would happen, do you think? What would happen if we adjust inflation upward? If inflation goes up, then that means the real rate's going to go down, and of course the after-tax real rate will go down. Using a 40% tax bracket is kind of steep, but so let's think about adjusting this for more traditional, more modern tax. So here is our Fisher effect worksheet, the one that we were just looking at. And again, if inflation increases, let's say it goes to 4, you can see that the after-tax real rate goes down. 3.5% was the number we started with. The current tax code is a little different, right? If you're an average American, your tax rate is probably a lot closer to 15%. So the difference, right, since you have a lower tax rate, your real rate is going to be higher than what it might be for a person that's in an upper tax bracket where their tax rate individually might be 38%. Now it's way down to 2.17, right? So obviously what? Taxes and inflation have an impact on your spendable wealth in the future. And that's really one of the things we have to think about. You can't avoid taxes. Taxes are whatever they are. But on the other hand, we need to be able to protect against inflation. We need to be able to have a plan to maybe minimize the taxes that we ultimately want to pay in our investments. So let's continue with our exploration here. So the next thing we can look at is we can look at something called the effective annual rate, or the annualized percentage rate, sometimes referred to as the holding period return. So you can see here we have an investment down below here. We bought something for $175 and that's worth $250. So if you held that for 1 year, your rate of return would be 42.86%. And again, this is the holding period return worksheet. Right? It's actually very simple. Plug in the beginning and ending values, the time frame, and it will calculate the return and the effective annual return, or the holding period return. In the second example here, we have, what if you had this exact same investment, but you held it for 4 years? Well, if you had it for 4 years, on average, each year you would earn 9.33%. So it's important to annualize these numbers so that we can make comparisons between different types of events. So the next slide is going to look at some real data. What it looks at and compares are treasury bills and inflation. And if you kind of ignore what's happened prior to 1956, you can see that in general, the increases and decreases to these two things seem to pretty much move in concert with each other. Now, they don't always move. Sometimes the inflation is greater than the T-bills, and sometimes it's not. But you can obviously, I think, see that things change over time. But if you understood what was happening to T-bills, this is implying that you also understand what's happening to inflation. So said another way, if you hear on the news that the T-bill rate increases by 0.5, what can you take from that announcement? If T-bills are increasing, most of the time that implies that the inflation rate is increasing. All right, so again, there's a very close relationship between T-bills and inflation, except prior to, quite frankly, it's from 1926 to the Great Depression right up through the end of World War II, right? But think about it, if you can predict T-bill rates, or if you understand them, you will now also have an understanding of inflation. So let's talk a little bit about some statistics. Now, before we get too far, there's going to be some calculations we'll do. You don't have to worry about the math. The math will be done by an Excel spreadsheet that I'll provide for you. So you need to be able to enter the data that we find, enter that data into the spreadsheet, and then it will do the work for you. But there are 4 basic statistics that we'll calculate. Expected return is the average. Statistically, we refer to this frequently as the mean. The variance measures the dispersion of potential outcomes. Standard deviation is the square root of variation, and it looks at the dispersion about the mean. So how are these things spread out relative to where the mean is? And finally, we have a statistic called the coefficient of variation. Probably should type that out just to help you a little bit. Coefficient of variation. This measures relative dispersion, and we use it for making comparisons. So let's continue on with our discussion here. So how do you calculate mean? Mean is quite simple, right? You find some probabilities and you look at some returns. So let me skip to the next slide and then we'll come back. Here's an example of a stock that we're thinking about investing in. We have some possible economic events, if you will. Excellent, good, poor, and crash. And we have predicted what the probability of these economic events is. Given these economic events, we predict prices, and then from prices, we calculate returns. So in this case, there's a 25% chance that an excellent economy happens. If an excellent economy happens, we expect to earn 31% on this investment. There's a 5% chance that a crash occurs. If a crash occurs, we expect to lose 52%. Now this comes from what's referred to as the standalone risk worksheet. We have yellow boxes. You plug in the probabilities, use decimal places for probabilities, and for the assets, you want to use the percentages for the assets and their expected returns. So down below here, the first thing we see is the expected return, 9.76%. So again, if we go back up here, this is the mean. It's the average. It's what we expect to happen. Now we can also do calculations on historical data. We'll talk about that a little bit later. But to find the mean, you take the probability times the returns and you add them up. I'll show you that in a spreadsheet here in a moment. The variance, you take the probability times the returns and then add those all up, and then in the end you subtract the expected return squared. So again, we'll go through these slides, but if you look down below, here's the variance is 3.8%. If you take the square root of the variance, the standard deviation is 19.5%. And in the end, the coefficient of variation is 2.0. The bigger the standard deviation and coefficient of variance are, the greater the risk of the asset. So we know the mean, we know what we expect to get, and we have a measurement of risk. We'll use standard deviation for individual things, coefficient of variation, to make comparisons. In this slide, I just want to spend a brief minute talking about how we come up with these numbers on a spreadsheet. So here we have the probabilities, here are the returns, and here I have formulas. It's the probability times the return. So you do that for all the events, and then the expected return is the sum of this column, 9.76%. In step 2, what you can do is find the return, 7.75%, minus the expected return, 9.76%, and square that difference. That's what these cells are, right? Then we want to find the probability that that difference occurs. So you take this number and multiply it by the probability. That's step 3. Once you have this column created, you sum them up. The variance is the sum, 3.8%. Standard deviation is the square root of variance. And the coefficient of variation is the standard deviation divided by the expected return. So the math is a little complicated, not terribly, certainly very easy with a spreadsheet. It could become a little difficult with doing by hand. So let's continue on. Another calculation or thing we might want to discuss is something called the Sharpe ratio. This is the reward-to-volatility ratio. So the excess return is the difference between the actual return and the risk-free return. A risk premium is what's referred to as the difference between the expected return and the risk-free rate. So the Sharpe ratio is a measurement of reward. Take the risk premium, in this case we take the return minus the risk-free rate, and divide it by the standard deviation. So in this case, the risk-reward ratio, or the Sharpe ratio, is 0.347. The higher this number, the greater return you get, the greater premium you receive, given the risk that you're taking on an investment. So that's the end of part 2. We'll start with part 1. We'll start part 2 in a second.